Dan, how are you, mate?
Very well, Pete. How are you?
Yeah, I'm pretty good. It's kind of funny because we love doing these shows in person. It's really hard when someone's in Australia, but I was obviously there recently, and now we're doing this one remotely. But I had a great time in Australia, mate.
That's good. Well, at least we got Danny here.
Yeah. Well, thanks for looking after us over there, and also just big thanks for everything you've done for me and Danny. Helped us a lot this last year. We've done a lot of good work with you, so appreciate that. But I do want to get into the mining stuff with you. We've obviously working alongside you, learned a lot about what's happening with the mining industry, learning a lot about new opportunities, the way different miners are expanding. So I've got a lot I want to get into with you, but I do want to kick off by asking you about this hit piece that came out again this week. I kind of hope we were past the FUD that keeps getting delivered by the mainstream press, but again, we had another hit piece come out attacking the mining in Texas. What's your kind of response to that now?
Yeah, we're actually starting to see the same hit pieces on traditional data centers. So the whole GPU uptick, the NVIDIA chips, generative AI, the power density of that compute. So I don't actually think it's necessarily isolated to Bitcoin, but I think the very simple answer to that question, Pete, is people conflate their view of Bitcoin and their perceived value of it with the energy consumption. So, it'll be the same people that will choose to watch Netflix instead of reading a book. It'll be the same people using a hair straightener because they don't like their curly hair, and then they'll attack someone for using a savings technology, which, as we know, is fundamentally transforming the world. So I think it's that conflation that explains it. And I think if you step back, if we never embraced new technology and we never wanted to utilize energy expenditure for that technology, we never would have invented fire. We'd still be huddled in our caves in the dark and the cold, right? Like energy consumption and humanity's ability to harness it for discretionary objectives is the heart of civilization and progress. So I think to try and stop that and get in the way of it, it's a bit like trying to stop an animal hunting for food, right? Like it's just ingrained in who we are as humans. So I think the other part of it is also conflating energy generation versus energy consumption. And this is where I think there is some nuance, and it's important to unpack it, because Bitcoin mining, traditional data centers, they don't emit carbon. They're not polluting. If we've got issues with externalities, which I think as a society we have an obligation to mitigate, then let's deal with those externalities. If that's environmental concerns, then let's go to the heart of where those environmental concerns come from, which is the generation of energy rather than the consumption.
Just going into that AI part now, because obviously you guys have expanded into using your data centers for kind of AI processing, but I don't see a scenario where the AI companies, well, there's this kind of belief where people would want to shut down AI because it uses up too much energy. But I think there's certain people who do want to regulate and shut down Bitcoin because of their consideration it uses too much energy. Do you think in some ways then that this kind of massive growth in AI may also become a bit of a shield and protection for Bitcoin in that both industries can kind of defend themselves together?
Possibly. I think the comment that no one will want to shut down AI because of energy consumption, there'll always be a group of people, but I take your point that it's probably a much smaller group than Bitcoin. Look, I think so, and look, to the extent Iris Energy ends up hosting a combination of AI and Bitcoin mining, does it make it harder to get grumpy at our business model? Possibly. I can see merit in that. I also think that we're dealing with two sectors that are emerging, right? We're at the forefront of technology, the forefront of social change, technological change, whether it's Bitcoin or AI. And I think as both of those technologies continue their respective adoption curves, more and more people will understand the technology, more and more people will get comfortable with it. And therefore, back to my earlier point, I suspect the resistance to energy consumption to fuel that is likely to abate somewhat. And again, I can go back to other examples completely off-piste. People want to use clothes dryers. They're too lazy to hang their clothes up on the line. Like, they want to watch cat videos on YouTube. Where's the outrage? Energy consumption is discretionary, and that's what makes democracies and our current world a wonderful place.
Just going on that AI bit a little bit more. I obviously haven't dug into what goes on with the data centers and how much energy data centers use for AI, but I would actually be kind of interested in the prediction, if there's been any models of future energy requirements, because I remember when, I think it was a Cambridge Analytics, a company, I can't remember which one, but did the future predictions for Bitcoin energy consumption, and it was completely wrong. But at the same time, it was kind of good to understand like the future use of energy by Bitcoin. But I imagine that it's going to accelerate a lot harder with AI because the growth has been incredible. I mean, it didn't OpenAI, wasn't that the fastest growing company or the fastest to 1 million users ever? And, you know, they use a vast amount of energy. Has any work been done on those prediction models?
Yeah, I think you're right. To be honest, you see them, you see these left to right increasing charts and X number of gigawatts by 2030 in energy consumption, et cetera. But I think the thing about forecasts, they're always wrong, right? It's the same as financial models. It's just how wrong, which direction. I think if you step back, the only reason AI, Bitcoin, anything will use energy in, let's pick an arbitrary date, 2030, is if it has value. So again, if you're a detractor of all these new technologies, don't stress. You know what I mean? Like, if these things go to zero, if no one has a use for it, if no one finds value in it, then don't worry. It won't use any energy. Just let it peter out. So I think in terms of the forecasts, to some extent, when you're at peace with the concept of energy consumption is a discretionary decision made at the individual level, which is reflected in aggregate amounts of energy at a societal level, just let people be. Don't intervene. If something's got value, it will use energy because someone sees value in it. If you're right, as a detractor of AI, as a detractor of Bitcoin, then just chill out. It won't use any energy if it doesn't come off, if nothing eventuates.
And so do you think that's a lot of the problems we're seeing then, is that people are focusing on the usage really, you mentioned earlier, focusing on the generation?
Well, exactly. So this is the other issue. It's if you've got an issue, like, what's the issue with energy consumption? You need to ask someone to articulate, why are you concerned that a kilowatt hour of energy is going to this? And normally, depending on who the individual is, you'll get a spectrum of we're boiling the oceans through to we shouldn't be emitting more carbon than what we should be able to otherwise. And like, I kind of get it, right? What they're alluding to is externalities, environmental concerns that occur and impact at a society level that aren't necessarily priced in at an individual power generation or energy consumption level. And I think once you identify that, the next stage is to say, yeah, completely agree. Where there are negative externalities as a result of an enterprise, we should absolutely look to address that. But you're not going to address that by shutting down new technology. Imagine in the 90s if we'd said, oh, the internet, it uses too much energy, let's shut it down. Like, we wouldn't be doing this podcast. We might be doing it in person, but it'd be pretty old tech. Yeah. So I think you then need to look at, well, power generation. If we have a concern with how power is generated and how we harness energy, then let's go and tackle that.
You've focused with Iris. You focused on using 100% renewable energy. You are a green company. You are focused on that side of energy generation, but you still get lumped in, I guess, with everybody else. So is it a weird place to be in that you've obviously recognized the need for consideration for the environment, but at the same time you are out there defending other companies who haven't done that. I don't feel you really exploit these opportunities. It's not like Iris comes out and said, well, we're green company, you defend the whole industry. Is that a kind of a weird position to be in?
Yeah, look, maybe we should do more about it, but I'd actually go back a step and say it's not just about using 100% renewables for us. When Will and I started this business 5 years ago, our energy philosophy was far deeper. It was not only will we use 100% renewables, because for us that just seemed a no-brainer, but we also only want to enter markets where our consumption of energy is solving problems in that energy market. So if you go back through our careers prior to Iris Energy, I was working across London, Sydney, developing solar projects, wind farms across Australia, Europe, chasing those feed-in tariffs in the mid-2000s. And no one at that time could have envisaged the carnage that these intermittent generators would cause on grids. And, it's all good intentions at the time, let's decarbonise, etc. But we end up with these massive fluctuations in the energy grid, and we've lost that resilience and consistency. So for us, we said, right, there's an opportunity here because, again, we're kind of going down into the details of the Bitcoin mining model. But all Bitcoin mining is we're manufacturing widgets, but we're manufacturing them at a nanometer level, at a microsecond intermittency, in the sense that we can throttle up and down live time. So in our head, it was like, well, there's all this overbuilt renewable energy, government programs, there's disincentives, you end up with lots of wind and solar concentrated in areas which isn't necessarily close to the load centres. So you've got times of the day where you've got massive oversupply and you've got times of the day where you've got undersupply. So doesn't it make sense to go to the source of that low-cost renewables? When the wind blows, the sun shines, we mop up that surplus energy. But as soon as the price spikes, because there's a weather outage, a network outage, a weather event, just people want to use power, i.e. the market, power prices peak, we can just switch off our miners or throttle them down, give that power back to the market. And yeah, it sounds, oh, you guys are such good citizens, how altruistic, what's your really agenda? It's like, well, no, it's a combination of things. So it's damn profitable for us to do that because we've got a higher and better use of the electrons we have contracted than the Bitcoin network. So every 5 minutes, it's very easy. We've got an algorithm that looks at the market price for power in Texas. There's 32 gigawatts of renewables in that area, only 12 gigawatts of transmission line capacity. So you get a lot of surplus renewables. Every 5 minutes, we look at the market price for power. If it's cheap, we turn those electrons into Bitcoin, which we liquidate for cash. If the market price of power is high because other people want it, then our algorithm automatically throttles down our chips, sells the power back to the market, and we've enhanced our revenue line. And we've supported the energy market.
So this is demand response, right? So for people who don't fully understand, you've done a lot there. I think we should just unpack it a little bit just so people fully understand. When you talked about this kind of expansion into renewable energies, wind and solar, and people didn't fully understand what the implication would be. Can you just explain in a bit more detail what that actually meant for the grids in terms of it being a less reliable source?
Yeah, for sure. So we can't control when the wind blows. We can't control when the sun shines, but we know that it's not 24/7. For solar, I would hope for our listeners that that's self-evident. For wind, it's equally the same. I mean, wind is essentially a derivative of solar and it will come and go. It will have different speeds at different times. So you end up with this variation or variability in the amount of electrons that are produced hour by hour throughout a day, let alone a year. This is a very big step change from the traditional energy market structure where you had 24/7 what they call baseload power, where you had a coal-fired generator, gas, it just pumps in the commodity, never switches off. It's just 24/7 baseload energy production. Now, the issue when you transition from that baseload to a model where wind and solar are just spitting out electrons throughout a day on an unpredictable basis, that doesn't correspond to demand. So demand might be high when the wind's not blowing. Demand might be low when the wind does blow. So all of a sudden you've got this mismatch. And this is why you're seeing a lot in Western markets, whether it's Australia, Europe, North America, a lot of governments and the private sector are looking at battery technology. They're looking at battery technology from the more typical sense that you would imagine, lithium ion, etc. And they're also looking at battery technology from the sense of like pump storage hydro, where you basically pump water up a hill during times of cheap power and then let the water come down the hill through a turbine during times of expensive power to sell it back into the grid. So there's a lot of value for these energy markets in being able to buy power low, sell power high, i.e., try and restore that equilibrium in the market. A battery can take power when no one wants it, give power back when everyone needs it. Bitcoin mining, AI data centers, all these applications that use energy that don't necessarily need 100% uptime on their consumption of energy are the perfect demand response, the perfect demand side battery, i.e., when wind is blowing and energy is cheap, we are able to monetize that energy into a productive end state. But when power prices peak because demand is high, then we can give that energy back to the market just as a battery would to help stabilize those networks.
And so is this because with wind and solar, you actually have to overproduce?
Is it a case of you have to? Possibly, but it's also a case of just incentives and economics.
Right.
So when you've got renewable energy which needs to be subsidised, and there's an argument to say that all energy production has been subsidised at one point or another over its life, but that's getting political and try to avoid that. But undoubtedly, when part of your business model for a solar farm or a wind farm is to get paid a renewable certificate, that is a portion of your revenue line which is different to or not reflective of underlying demand for that electron. So you end up with these perverse situations where all this wind and solar gets built out in the desert where it's cheap, there's lots of wind, there's lots of sun. You get that renewable energy certificate because that's a regulated instrument that you can monetize, but there's no load out there. There's no one to use it. So you just ends up with wind farms in the desert spinning. So that analogy isn't quite what we've got in Texas where our facility is, but it's kind of directionally that way, i.e. go back to those numbers I just mentioned. There's about 32 gigawatts of wind and solar projects. The transmission line to export those electrons down to the load centers in Dallas, Houston, etc., is 12 gigawatts. So it's inevitable that you're going to end up with large periods of oversupply.
And a Bitcoin miner is most suited to provide this service to the grids because obviously you mentioned you can throttle up and down pretty quickly. I know historically it's been things like paper mills and steel plants really that have been powering up and powering down. But you can almost do it instantly. But also being so price sensitive, you can react instantly to any changes in price.
Yeah, exactly. And I think a lot of traditional industries and manufacturing has tried to do this, but when you're dealing with physical commodities, physical production, the real world's harder than the digital world. You want to talk about steel, like you've got these big, what are those melting pots, the furnaces where like you can't just power that down for 5 minutes. Like some of those things take days to restart, to warm up, etc. So demand response is very challenging. But when you're dealing with chips on a board and it's all digital, and then you can integrate that into a software algorithm that just puts them to sleep, at an instant, you can see how it becomes far easier for an industry like Bitcoin mining or anything digital to respond to those market needs.
It's so funny. It feels like Bitcoin mining has become like a gift, an unexpected gift to grids in that it can offer so much, yet it's still getting attacked. I mean, I know in the article, I think it was ERCOT they were attacking out in Texas. But my understanding is that without the Bitcoin miners, the ERCOT grid could have potentially failed. Is that being hyperbolic?
Oh, look, I think that everyone loves to deal with extremes, right? So I think undoubtedly Bitcoin miners have helped that grid. And I think the governor of Texas even came out there with a very pro-Bitcoin mining tweet about 4 weeks ago because they can give power back. So on the first hand, they underwrite new renewables because they bring demand into the market. So when everyone's trying to decarbonize, this is actually worth exploring because it's the other side of the equation. The issue we've also had in Western economies is the decline of industry, the decline of manufacturing. So that's reduced energy consumption at a demand level. We've had the rollout of solar PV on rooftops, et cetera, reducing net retail demand. So you've had demand for energy fall, yet we're trying to transition our energy generation fleet away from coal and gas towards renewables. So you end up with this dynamic where you're just flooding the market with more power. At what point do you shut down fossil fuel generators, embrace renewables, etc.? So the benefit of data centers, Bitcoin mining, AI GPUs is it brings load back into these energy markets that can underwrite and actually provide a demand signal for more renewables. Because we got to this point where the low-hanging fruit was taken easily and quickly. You were able to build renewables. The incremental demand was kind of there. There was a market price signal. If you want to keep pushing more renewables onto the grid in the absence of a price signal, in the absence of underlying demand, there's only one group that pays for that. It's the taxpayer. So again, you've got Bitcoin mining underwriting this green transition towards renewables in terms of the new energy build out. But then you've got the same industry sitting there once it is built saying, you know what? If anyone wants this power beyond a certain price, then you can have it. We actually don't want it. It's not that economic. We'd rather sell it back and give it back to you. We'll just mop up all that cheap power when there's too much wind, when there's too much solar, and provide a floor price for these generators to get up and build. But the moment that anyone else wants that power because they want to watch cat videos on YouTube or do whatever they want to do, discretionary with their power, we'll give it back to you.
Who's paying for the power when it gets expensive at that point? Is it transferred to the retail customer themselves? Are they paying variable prices, or is it the grid and they balance it out?
Oh, it depends is the long answer. So that's the short answer. The longer answer is more complicated. So it's like any traded market in these deregulated markets, whether it's every 5 minutes or 10 minutes, you've got a bid and an offer for power and you've got a market clearing price. That's at a wholesale level. But then when it comes down to an individual customer level, then it gets more complex. So at a retail level in different markets, it will be a regulated price where you won't be able to pass through all of that price on a 10-minute basis to your customer. It'll be fixed, and then every year you might have a reset. You'll then have larger wholesale customers that might have partial hedging contracts where they fix part of it. Some of it might be passed through, etc.
Right. So going back to ERCOT, why has so much of this work with demand response been so focused in Texas and ERCOT? Because I've heard obviously about you guys and other people working out there. What is it that's unique about Texas? And also, is it actually happening anywhere else? Because I can't tell you off the top of my head that I've heard of another grid that's doing demand response.
So there's probably two things there. One is Texas is a good place to do business. Okay. I've never really had much to do with Texas throughout my career, but their approach to business and an open market is absolutely spot on. So it's a nice place to go. Things are easy. People are focused on getting stuff done. There's no excessive red tape. So that's one element. But I think to then look at the demand response element, it's renewable energy, and it's the absolute amount of energy. I haven't checked in the last year or so, but my recollection is that if you looked at Texas as a renewable energy generator, like in terms of the aggregate amount of wind and solar in that market, and mapped it against all the other countries globally, it would be top 10, even top 5 renewable energy producer globally. Like, it is enormous, which is not what people expect.
Kind of ironic.
Yeah, and no one expects that. They go, well, hang on, like Texas is like...
Texas?
Yeah.
Oil country.
Exactly, yeah.
Oh my God. So the grid themselves, the ERCOT grid is pro this. They support it. They're happy. Texans are happy. It just sounds like the people who are interfering are people in different states, maybe senators who are in different locations. Well, I know I'm being facetious because I know Elizabeth Warren has been attacking this, but it does feel like it is to me. It's people outside of Texas who are trying to influence this.
Possibly. There's probably people within Texas. There's probably more people outside of Texas.
Right.
Look, to some extent, that's healthy, right? You need different views. That's what makes a market. You need people to be challenged. But yeah, there's a point where it gets a little bit too far.
Is there enough space for all the miners to go out and support this? And is there even a risk that you get too much centralization of mining within places like Texas or in America if they get too advanced of everyone else?
So why don't we step back?
Yeah.
What's mining centralization? How would you define it? What would the concern be?
Regulatory capture.
But what's the end outcome? Why do we care?
Because we want as much hash rate on the network as possible as a security protection for Bitcoin.
So
own me here, come on.
Yeah, I think that's right, but people will then step it down and go, 51% attack. We need a secure network. Bitcoin was secure when there was half as much hash rate. So to unpack that, Texas shuts down, global hash rate halves or goes down 30%, whatever the number is. What happens? I think we saw that happen firsthand with China a couple of years ago. Nothing. Block times slow down for a little while, network difficulty adjusts, the network goes on. So what's the concern? We lose a market, it grows elsewhere. Next. The other concern that people will often raise is a 51% attack. And this word, I just don't get it. You cannot do anything with a 51% attack. You play it out. People love throwing this around. We saw it with other coins from time to time. And you can't do anything. The only thing you can do with a 51% attack is try and double spend your own coins. You can't steal other people's coins. You can't stop the network. And it's bloody expensive to continue to try and attack the network. So the only really issue is if someone gets 51% of the network, they could theoretically send some coins to an exchange, sell them, withdraw the cash, and then 2 hours later, because they've continued to mine the chain a different direction, go back, spend the same coins again and pocket twice the cash. It's does that really worry me? Does it worry 99% of the users on the network? No. So I think regardless of the theory behind a 51% attack ever happening, even if it does, it's a bit of a non-issue.
Well, and I guess if you're going to try and double spend your own coins, you have to have enough coins to make it worthwhile to begin with. You have to have an exchange that's willing to buy them at the other end, and you've got to be expending that huge amount of hash rate at the start. But I guess sometimes people worry about more of a nation state attack to be disruptive to the network.
Yeah, but like everything in Bitcoin, it just seems to have solved all the incentives, and it's just anti-fragile. Right. So, and an adjacent thought bubble to that, Pete, is people say, what happens when you got to whitelist coins and you get blacklisted coins, and you've got government Bitcoin network and then shadow Bitcoin network, i.e. if you want to transact in Western worlds on the Bitcoin network, you must be KYC'd, you must do XYZ, you must go through an intermediary and pay them a centralized fee like a bank. Well, what happens? Not all of the hash rate is concentrated in these Western economies, and you don't need much offshore to fundamentally change it. So let's say you've only got 5% of the global hash rate in non-Western economies that are enforcing these KYC and white label initiatives. That just means 1 out of 20 blocks is getting found outside these jurisdictions. How much are people going to pay? If there's demand for that, fees are going to be enormous. So that 5% of miners that are processing transactions that aren't white labeled or whatever arbitrary overlay we want to apply to it, they're getting paid a fortune. So naturally the market kicks in. What are people going to do for the hash rate outside of these non-Western economies? They're going to grow it, right? Because the economic incentive there is to do it.
And so you wouldn't, I guess, even worry about kind of OFAC compliance and the censorship of transactions, because even if that does happen, there are going to be miners outside of the US who may ignore this, and it just means you get found in a later block or you get processed in a later block.
100%. You might have to wait a bit longer, you might have to pay a bit more, but again, at an individual level, you're willing to do that because you see value, and if you don't, you'll stop using Bitcoin.
You mentioned a moment ago, you talked about the hash rate going up so much in the last year. I still can't understand why it's gone up so much. I mean, I'm obviously not as close to it as you as you are, and the hash price is getting crushed. Is there kind of any obvious reasons why this is happening?
I think this cycle's been a little bit different. The main reason is access to capital. So during previous Bitcoin bear markets, the money dries up completely. Everyone's emptied out. The rest of the world's not interested. There's just no capital left beyond kind of reinvesting some of your own money. I think this time's a bit different because you've got the listed market. You've got 15, maybe even 20 listed Bitcoin miners, all with varying levels of access to capital. A couple of the miners are still trading on, $1 billion plus valuations. They've got access to capital. They're able to buy more machines and continue growing that through the cycle. In parallel, you've got manufacturers that are continuing to produce the chips. They're solving the price of those chips for market supply-demand dynamics, i.e. when Bitcoin mining profitability is lower, the chips are priced lower so people can afford more. And I think this is where it varies a lot to traditional industry as well, because you can invest throughout the cycle profitably as a Bitcoin miner because a large part of your CapEx is linked to those special purpose chips that have no alternative use, and the price of those chips is linked to profitability. So when Bitcoin mining profitability is high, we're in a bull run, you pay a fortune for those chips. When Bitcoin mining profitability is lower, you don't pay as much. So you're always generating a decent return on your capital. And I think the comment around Bitcoin mining profitability today, it's still profitable. You look at S19J Pros that were released a few years ago, they're still break even around 8.5 cents a kilowatt hour. If you're mining in Texas, you're at 2-3 cents. That's a pretty good margin by any account. You buy the latest S21 series that was released by Bitmain a couple of weeks ago, that's 14 cents a kilowatt hour as your revenue line. Well, they're good margins, so people are going to continue to invest.
I can't believe everyone is getting those margins, and also a lot of people using old machines. So, I mean, do you think Bitcoin mining is almost the most aggressive example of how a free market should work?
Again, absolute language. I think it is a good example of how a free market should work. There's too much absolute language in this world. I think the reason it is because there's very low latency throughout the value chain where it's a very pure price signal. There's no interruptions. There's no customer contracts. Everything's open. Everything's transparent. You buy a machine, you ship it, you plug it into a PowerPoint, you then receive an amount of value for that is very liquid, transparent, observable, being the Bitcoin price. And I think that makes it a very pure price signal where people can invest. They can invest with confidence knowing how the economics work. Yes, it's volatile, but it's a very asymmetric volatility, which I can expand on. But because you haven't got all these intermediaries, you haven't got these other exogenous factors impacting on the price signal, it does make it a pretty pure form of market, yeah.
Can you unpack that asymmetric? So how did you say it?
Asymmetric. So when we were out raising our seed rounds, 4 or 5 years ago in Australia, people say, but Bitcoin is really volatile. How do we get our head around it? Well, like every market, you're rewarded for volatility. Arguably, you're rewarded more in this sector because people don't get it and there's not natural capital chasing it yet. Now, as I mentioned earlier, that's absolutely changing. So you look back over that time period and historically, you can buy these Bitcoin mining chips on 9 to 12 month cash paybacks. You plug them in, you get all your capital back within 9 to 12 months, right? That's not bad. That's a pretty good reward. You say, okay, well, I'm getting compensated for my risk. And then from our perspective at Iris Energy, we've built, long-term data centers, which, as you mentioned earlier, we're looking at AI, NVIDIA GPUs, etc. So you build this long-term data center infrastructure. We then monetize it through this Bitcoin mining where the chips are paying themselves off pretty quickly. So you go, all right, that's kind of interesting. So that's the asymmetry in of itself where you've kind of got all this optionality on a data center platform. But if we then unpack asymmetry in the Bitcoin mining model specifically, this is where it gets really interesting. So we'll start with what happens when the Bitcoin price goes down. all of a sudden that 9 to 12 month payback starts stretching out, right? It gets longer and longer because you're getting less and less cash. But what you encounter as a low cost miner is this unique downside hedge. You've got this protection because as the price of Bitcoin goes down, high cost miners can no longer pay their power bill. All those people hosting at 6, 7, 8, 9 cents a kilowatt hour, they can't pay their power bill. The machines switch off, the global hash rate reduces. So if I'm sitting here with 5% of the global hash rate today, Bitcoin has a 40% drawdown, and we see the global network halve, all of a sudden I've got 10% of the Bitcoin. I've got 10% of the global hash rate. So I've got this volume hedge where if I was producing Bitcoin at $10,000 a coin prior to this event happening, I'm now receiving twice as much Bitcoin, halving my unit cost of production. I'm now producing at $5,000 a Bitcoin. So all of a sudden, if you're a low-cost producer as a Bitcoin miner, you've got this really unique downside protection, this volume hedge, by basically getting the benefit of everyone else's Bitcoin when they have to switch off. And that's very unique compared to other commodity industries, gold, copper, iron ore, etc., where, you're protected as a low-cost miner because you can continue to operate throughout those periods, but you don't get a volume hedge as a gold miner. You don't get twice as much gold in your deposit when that happens. So that's on the downside. I'll pause there and then we can play it out as the Bitcoin price increases and I can show you the other side of the asymmetric outcome.
Yeah, because I've just got a question on that. So that basically means though it's still that the competition here is for the cheapest energy price possible. And I know there's other factors, and you guys have been very good at working on your efficiency of your machines, but essentially it's a competition for cheap energy.
Absolutely, it helps 100%. And I think part of that demand response and that algorithm we've got enhances the proposition even more because, frankly, we can goal seek our power price. We can decide what power price we want. We can wake up tomorrow and say, let's solve for 2 cents. Let's solve for 4 cents. And we can flex that depending on where we're at with the Bitcoin cycle. The reason we can do that is because we have 2 buyers of every electron of power that we've contracted. We've got the market and we've got the Bitcoin network. So if we want to lower our cost of power for the Bitcoin network, we just sell more power back into the energy market. So for example, the best way to conceptualize this is if the break-even power price for one of the Bitcoin mining models is $80 a megawatt hour, every time the market price of power is above $80, we're better off selling that electron back into the market. If mining profitability drops such that the break even for that same miner is now $60, we just sell every electron above $60 back into the market, lowering our cost of production on the Bitcoin mining side. So this is kind of a second derivative of how we manage that asymmetry and that downside protection, but that's kind of distinct from the broader market structure and the asymmetry of the price and hash rate relationship.
So demand responses reduce risk on both sides. It's reduced risk for the grid, but it's also reduced risk for the miners yourself.
100%.
That's incredible. It's weird because I don't really hear a lot of people talking about this. I always hear them talking about the fears for miners if energy is too expensive. But I guess you're structurally set up, and I know others are doing this, structurally set up to de-risk this. Does this also play out the same through the halving? Because we got a halving next year, and traditionally people like me and Danny probably get super excited by a halving because we're convinced there's less supply, so the price is going to go up. But historically, it's been a challenging time for miners. Like, how does it play out for you guys with that?
Yeah, it's a funny question because, as you say, you get a cohort of people that go, can't wait for the halving. 3 to 6 months later, that supply shock kicks in. We get another parabolic bull run, etc. Happy days. And then you get other cohorts that say, oh, I'm really worried about mining rewards halving. What's going to happen to your business model, assuming the price doesn't move? And so, the Bitcoin price kind of has to move, but that's a tangent. I think The easiest way to conceptualize from a mining economics perspective the impact of the halving is just go back to the price. So the way to think about mining is every 10 minutes, there's a bounty available for miners, right? Which is a function of the number of Bitcoin available multiplied by the price of Bitcoin. Now, whether you flex the price of Bitcoin or whether you flex the number of Bitcoin available, it all ends up in the same place, which is there is a fiat-denominated bounty every 10 minutes available for miners to get a share of. Now, if you've got 1% of the global hash rate, you get 1% of that Bitcoin available. So if the number of Bitcoin goes down, you're getting less. If the price of Bitcoin goes down, you're getting less. So it doesn't really matter which one you flex. So if you go back to the earlier example I just gave, the impact of the halving, if you've got an $80 a megawatt hour revenue line or break-even line for a miner, after that 10-minute block, it goes down to $40. And that's where you see people that have to pay more than $40 go, hang on, I'm now operating at a loss. What do I do now?
So really, when people talk about the halving can potentially be a bit of a bloodbath for miners, it's really a bloodbath for those who are paying a high price for their energy.
Exactly. And then, for those that have access to larger scale, cheap renewables, absolutely across the space, that 10-minute block, we're going to see our revenues go down, but equally we're going to have that asymmetric downside protection and the benefit of getting those people's coins as they inevitably have to shutter.
Can you talk about the upside as well? Because you mentioned both. I obviously jumped in there.
Absolutely. That's far more exciting.
Yeah.
I say that tongue in cheek, but for us, it was actually more exciting, the downside protection and the resilience in the business, because we understand the exponential upside. We'd already bought into that. So the really exciting part of us setting up this business was understanding the level of downside protection and ability to travel and traverse those tougher periods. So, okay, upside. So we've just played out when Bitcoin mining revenues get hammered. Now, whether that's a halving event, whether that's the Bitcoin price dropping, we've explained how it's the same thing in terms of impact to miners. Now, as the price starts recovering, high-cost miners walk over to their power points and they can switch them back on, and the hash rate can follow the price. Now, that can only happen, however, until you hit the old high watermark for global computing power, at which point there are no more computers to plug in. And this is where you get the real dislocation and the exponential upside, because at that point, you've got this digital commodity, getting bootstrapped as a monetary asset, post halvings, it goes on these 5 to 30x price runs, and people say, wow, we've got to bring on more mining supply. Bringing on more mining supply and global hash rate is not digital. It is the real world. It is the physical. And the bigger Bitcoin gets, the harder it is to do this, because you're dealing with power, you're dealing with infrastructure, you're dealing with large-scale capital logistics of buying computer chips. It's not unlimited. You can't click your fingers and conjure all this stuff, plug it into a PowerPoint and grow the hash rate. So when we started this business about 5 years ago, what we did is go back through every Bitcoin cycle historically and understand what was the relationship between the hash rate and the Bitcoin price at every point. And what we learned, and we've got some cool charts that show this, is every cycle it was getting longer and harder for the real world to keep pace with the digital world. It was getting longer and harder for the hash rate to keep pace with the price. So the last cycle before we set this business up in 2018 was the 2017 bull run, where you had Bitcoin run to $20,000 and then crash. So the hash rate just couldn't keep up with the Bitcoin price. It wasn't until 9 months after the peak that the hash rate caught the price to normalize mining profits after the price had fallen 70%. You then go back to the last cycle that we saw. So sitting here today, we saw Bitcoin run to $60,000 a coin. If you look at where Bitcoin was prior to that run, you had 6 to 8 gigawatts of power securing the network. Bitcoin was $8,000 to $10,000 a coin. So the market's in some sort of equilibrium where miners are earning a return on their capital, and it's kind of normalized so far as the industry is concerned. Bitcoin price then runs 5x in 6 to 12 months' time. How do you 5x 6 to 8 gigawatts of power? The entire global data center industry is about 20 gigawatts, and all of a sudden you want to click your fingers and come up with 30. It doesn't happen. You need tens of billions of dollars. You need all of the power, the infrastructure, and we can talk about how hard it is to develop large-scale energy infrastructure and actually get access to these electrons. You need to somehow solve a semiconductor shortage and conjure out of thin air billions of dollars of these chips and steal them away from other industries. So this is the asymmetry that occurs, and why, if you go back through history, when Bitcoin runs, everyone goes, oh, where's the hash rate? It's not responding. Well, it can't. You're dealing with physical limitations that do it. So that was the exciting part for us. We saw it in the last cycle, and we'll see it again.
So there's a large escape velocity for Bitcoin as the network grows. Yeah. That's great for your business. Yeah. Can we talk a little bit about the AI now? How that, you've been getting into that business. I want to understand a bit more about it. We spoke about it in Australia, but obviously that was on stage and people would have heard that. You guys are expanding into AI, including AI within your data centers. What's the correlation between Bitcoin mining and, I don't want to say AI mining, but like the AI side of your data centers?
Yeah, so I think this is interesting, and it goes back to the kind of the genesis of our business, which is not to be crypto miners. Like, we've never subscribed to the whole sea can and shipping container in a desert mentality, finding old abandoned warehouses. We've approached it through the infrastructure lens. So most of our backgrounds is in traditional infrastructure, ports, airports, commodities, renewable energy projects, gas pipelines, etc. So we kind of think through a 20, 30-year lens when we're building and operating stuff. And our thesis was you build power-dense data centers in a world that's becoming digitized, electrified, everything's going online. We've got that physical, linear world ability to build that infrastructure, but all these digital exponential demand drivers, whether it's the Bitcoin price, whether it's online energy consumption, generative AI as it turns out. So that's a really interesting position to be in, where you're monetizing an asset base that is harder to bring online supply-wise because it's the linear world, and you're monetizing it into an exponential demand curve. So that was kind of the thinking around it. So we've got these data centers, Bitcoin mining. We love Bitcoin, went down the rabbit hole there. That's another story. Thought, perfect. You buy these chips, plug them in, they're spitting out 9-12-month cash paybacks, bootstrap the platform, wake up in 5 years. And another analogy I'd use for that mentality was almost modern day farmers. So if you step back and you look at agriculture, right? What are the core ingredients of farming? You've got to have access to land, and you've got to have hydrology. You've got to have access to water. Now, once you've got those core ingredients, what you farm, what you grow, how you monetize that, you can flex as markets come and go. One season you can be growing wheat, the next season you can be growing something else. For us, it was the same thing. In this world that's becoming electrified, digitized, all this renewable energy getting built, go and lock up those factors of production. Go and lock up low-cost excess renewables, build the data centers, own the land, the infrastructure. How you monetize that 5-10 years from now, yep, Bitcoin will probably be here, but who knows what other possibilities will emerge. So that was really exciting for us. Going back to your question more specifically around the AI, we did sign an MOU with Dell about 3.5 years ago to start looking at non-Bitcoin applications for these data centers, leveraging their hardware and customer base. But at the time, the opportunity cost of time, capital, resources, etc., for a growing business, we parked it. Now, back to where we are today. The last 6 to 12 months, the explosion in generative AI. the image side, the language model side. As we mentioned offline, I was in San Francisco last week. Like it's on, right? And I'll say that with caution. Like all these industries tend to go through kind of boom and bust cycles first, but fast forward in 10, 20 years, ignoring the trajectory of how we get there, it feels like we're on a path that's kind of pretty fundamental in nature. So where we stand today with our data centers is we've developed from the ground level, first principles, these proprietary data centers that are optimized for power dense compute. Now, why is that important? Because it's very different to how other data centers are built and the genesis of where they've come from. So if you look at capital city data centers, typically they're optimized for very different things. They're optimized for high reliability, very low latency, mission critical applications, hospital systems, government systems, people working on their shared drive in the office where you want to double click on a document. You don't want to wait 3 seconds for it to open every time. Now, the thing about those facilities, it's all about power density. Historically, 10 to 15 kilowatt racks. So you've got a big structure in your data center, the CPU's in there, 10 to 15 kilowatts of energy consumption. Our ASICs, now park whether they're used for Bitcoin or anything else, at the end of the day, they're chips. ASICs, application-specific integrated circuits, they're just a more energy-dense chip that's concentrated on a specific outcome. Now, we're doing 70 kilowatt racks, 70 kilowatt racks, right? And we've had to do that. We've had to develop it from the ground floor and work out how we manage ventilation, airflow, networking, infrastructure, etc., to manage those most efficiently. Now along comes generative AI, NVIDIA GPUs, it's starting to explode. They use 40 to 50 kilowatt racks. Now look at the two markets. You can be in Camp A, historically dealing with 10 to 15 kilowatt racks, and go, how am I going to 3x this? Or you can be Camp B, where you say, I've been dealing with 60% more power density. To plug them in doesn't seem that complicated. So that's the really interesting opportunity for us. As you alluded to before, we've bought some of the NVIDIA GPUs. They're arriving in the next few months. We're equally in conversations with parties around BYO GPUs, what they call co-location. We're excited about it. It just looks absolutely fascinating. The combination of that industry, Bitcoin mining, feels like we're on the cusp of another growth trajectory.
So what is a BYO co-location? ASIC?
Yeah, I skipped over that a little bit. Broadly, there's two models when it comes to managing these GPUs that are used for generative AI. As a data center owner, we can buy and operate the GPUs, so the computers themselves, and monetize that via a cloud service, i.e., we've got GPUs. If you want to use them, pay us X number of dollars per hour that you use them. The alternative model is we've got infrastructure and data centers and PowerPoints, and they're scarce. You've bought the computers. You need somewhere to plug them in. We can plug them in and operate them for you and manage all that end infrastructure. So the analogy for Bitcoin audience would be self-mining versus hosting.
Right. Yeah, I get it. Do you think there'll ever become a scenario whereby you guys will be balancing between whether you use your energy for AI or we're using it for Bitcoin mining, almost like your own demand response within the services you provide?
Yeah. We were chatting this morning about it. It's like fast forward 5-10 years, where are we? And it's kind of ironic, as I said earlier, when we set this business up, we're being asked to talk about what the business model is. And we said, fast forward 5-10 years, we don't know where we'll be, depending on how different markets emerge and the economics and the ability to service that. Will pivot our business accordingly. Unfortunately, that doesn't always resonate. Investors like certainty and say, we want you to be 53% this and 48% and 47. Can't add up to 100. So it's something we're working through live time. The reality of sitting here today is we're 100% Bitcoin, except for the initial purchase of those NVIDIA chips. But fast forwarding, 3 months, 6 months, whatever it takes. Like, I think the Bitcoin proportion will start reducing, but we'll never let go of Bitcoin, right? Like, it's the backbone of our business. We're believers in it. It'll be a portion, but what it looks like in 5, 10 years, something else will probably pop up in that time, to be honest.
So the AI thing, is it more because you've got this infrastructure, it's a booming market, sometimes, you can't always, like you said before, you can't always maybe scale into Bitcoin if you go into a bull market and the chips aren't available, you might as well use the infrastructure for something else? Or is it more about, I'm guessing the revenues from AI, I keep saying ASICs, but they're GPUs. Is that just like a more reliable, steady income, so it gives the business more stability?
Yeah, look, at its heart, we go back a step. It's about locking up low-cost excess renewable energy and building infrastructure that can monetize and transform that renewable energy into digital applications. So you've got the real world, the scarcity of supply of megawatts, power, infrastructure, the linear ability to scale that, contrasted with a revenue line that is the exponential world, whether that's Bitcoin or whether it's the current generative AI push. You can't scale the real world fast enough. So just as the Bitcoin people found out a couple of years ago, now the generative AI people are finding out there's not enough data centers. Even if they can get chips and there's 6-12 month waits on those chips, once you've got them, you need a power point to plug them in. And to the earlier point, a lot of the traditional data centers can't plug them in, or if they do, they've got to plug them into an empty room and remove all the other applications because they can't manage the power density. So it's the same phenomenon playing out. Now, in terms of the various business models and stability of income and volatility of income, etc., look, it's risk and return, right? Like, if you sign a 5-year contract in generative AI to host someone's GPUs, that'll be at one price. If you self-mine Bitcoin for the next 5 years, that'll be another expected return. So it's one thing to sit here and say, what are the expected returns on each business? But you've also got to look at the other side of the coin. What's the cost of capital in fueling and promoting and investing in those sectors? Now, I don't think it's any secret that Bitcoin mining doesn't trade on the greatest of earnings multiples. It's pretty slim. But if you look at traditional data centers, traditional technologies, we're talking many, many multiples, even orders of magnitude differentials. So if we can navigate through and optimize that cost of capital and deliver the investor market a product and investment thesis that they find compelling, then that'll hopefully liberate more capital for us to continue growing and investing in both Bitcoin and AI.
It's another interesting thing with that's come out of this Bitcoin, because I always think the unknown unknowns is the most interesting part of Bitcoin, in that when I first got into Bitcoin, I heard about it. It was a network for sending value around to people in a decentralized peer-to-peer network, and Bitcoin mining existed, but it wasn't something I'd paid too much attention to. And it feels like over the last few years, the industry has changed rapidly. It's become a lot more competitive, but a lot more industrial scale. But we've had these kind of like things that people didn't really expect, that you can put Bitcoin miners on a landfill site, and you can burn methane and do a net benefit job for the environment, and convert that into Bitcoin. Or that you can integrate with the ERCOT grid, and by integrating with the ERCOT grid, you can make the grid more stable. But just right now, I've just thought, well, actually, another thing is the way that Bitcoin mining works, the competitive nature. It's forced companies like you to learn how to build the best, most optimized data centers, and so that's put you in a position where you're also an ultra competitive builder, constructor of data centers.
No, that's right, and that just happens to be our DNA: building, owning, operating infrastructure. And I think there's a couple of things that have changed when you look at Bitcoin mining specifically. One is the absolute size of the industry has exploded by virtue of the price of Bitcoin and the overall revenues available to the market, which necessitates a order of magnitude increase in the size of the infrastructure, the amount of energy that's used, etc. So naturally, you're going to see a transition more towards institutional capital. It's going to be more spoken about because more people are doing it. And I think that's been compounded also by the changing nature of the competitive advantage over the last 5 to 7 years. So if you go back that length of time, competitive advantage was dominated by manufacturers of these chips. They had access to the latest technology. So if you go back through the history of mining to set some context, 10 years ago, we're dealing with people in their parents' basements with a CPU, just a computer or a laptop, right? Mining 50 Bitcoin every 10 minutes, happy days, time machine, that's probably the first place you'd go. People then realized that you could program GPUs to run this algorithm faster, more energy efficiently. Now, you probably still kept them in the basement because they were generating a lot of noise and heat relative to the CPUs, but people could scale, they could buy them, and you could keep pace with a network that wasn't growing as much in absolute terms as we discussed earlier. And then around, I think it was 2014-ish, the ASIC manufacturers entered the market. And they said, you know what? This market's big enough. We've got the smarts and the know-how. We're going to develop special purpose chips whose sole purpose in life is to crunch this algorithm as faster, more energy efficient, etc. Now, from that point, they held the competitive advantage because they had access to the latest technology. So what would happen is they would mine on the latest chips, 6 months later, develop a new chip, sell the old stuff to the general public, rinse and repeat. So as the average punter, you had no way of competing with these guys because they were iterating the technology so quickly. It started off at like 150 nanometer gate width on the transistors. We're down to like 5 now and even pushing 3, right? But for that period of time, the tech curve of Bitcoin mining was chasing the technology curve of traditional computing. So you had traditional computing going like that. I don't know if that looks left to right on, hopefully it looks the right way on the screen. And then you had Bitcoin starting up here and chasing down to that tech curve. So while that was happening, the manufacturers would self-mine. Once they developed a new chip, they'd sell the old stuff to the general public. So you couldn't compete with these guys. So what we could see coming was the commoditization in relative terms of those chips because they were approaching the efficiency of traditional computing. Lo and behold, that happened. That happened many years ago, where all of a sudden the manufacturers of Bitcoin mining machines are competing with the likes of Google and Amazon to buy wafers from TSMC, Samsung, etc. Now, that's not to preclude additional technology gains. Like humans don't sit still. We get better at doing stuff. There will be innovation. But in a world where all these manufacturers are now restricted with their ability to advance and become large-scale manufacturers, they've turned more into kind of widget manufacturers rather than technology hubs per se and realize, well, hang on, our business model is about selling this gear rather than self-mining per se. And what that did was completely shifted competitive advantage in the sector away from who had the best chip to who can build large-scale infrastructure businesses and access institutional capital markets to scale.
Dan, in the time you've been involved in this in mining, what thing has changed most for you? Where you've thought one thing, and here we are years later, and you've realised it's another thing. Because it feels like mining has changed just so much.
I think it's probably the growth in the hash rate over the last 2 years. Has caught a lot of us by surprise. And in hindsight, like everything, it's explainable, and whether or not it's real or not, humans will always attach a narrative to something. And I did that. I said, oh, look, this time might be different because of access to capital. But I think that's real. If you look at the 15 to 20 listed miners, they've continued to raise capital over the last couple of years and deploy that. And we've raised a bit recently as well, and we're growing. A lot of our peers are growing as well. That's probably the one area that I probably didn't consciously think of at the time.
So what's coming up for you guys then? What are you working on?
Oh, it's always stuff. To be honest, it's we announced last week we'd bought some of those new generation S21s from Bitmain, which will get plugged into our Texas facilities early in the new year, and in parallel, really bottoming out the best way to enter this generative AI space. And as I alluded to earlier, like I've done a lot of personal reflection on this, and mucked around with a lot of the applications, and you helped me get onto Midjourney over an old fashioned, which I appreciate.
Are you now pretty addicted to Midjourney?
I am. Everything from like coloring in pages for the kids to printing pictures. Like, it's pretty cool, the stuff you can do. So
have you used it at all for like interior design?
Interior design.
Yeah. So you can say, so if you've got you want to do your garden up, or if you wanted to do your, redo your bathroom, just tell it the kind of style you want, and it will come up with some designs for you. And if you think it's kind of right but not there, you can just give me a subtle variation. It's unbelievable. The interior design bit is incredible.
That's super helpful. We're building a house at the moment and trying to decide on a few areas, so I might give it a go after this.
Yeah, it's crazy. Anyway, sorry. Go on.
No, look, and I think you kind of step back and you go, where's this AI stuff going? Like, how sustainable is it? Because we're building infrastructure, we're making investment decisions. You kind of need to form a view on it to some extent. And the conclusion that I think I've got to is it's not going away. In fact, it's incredibly profound where we're going. Fast forward in 10 years, and you listen to podcasts. There was one with Lex and Mark Zuckerberg recently, a bunch of others. You just listen and see what's going on. As I said, I was in San Francisco last week. This stuff is not going away, and I think the level of impact it's going to have on us as humans and how we interact with each other, how we get stuff done, how we communicate. We can't even contemplate what the world's going to look like in 10 years. And I don't say that lightly. Like, I think this is going to be extraordinary. But the caveat I have to all of that, as I mentioned earlier, is the trajectory by where we get there. Like, the VC funding's flowing into these generative AI startups. People are going to succeed. People are going to fail. We tried to do AI many decades ago, and we didn't have the technologies. Something popped up that held back progress, and we went into what they call the AI ice age for a protracted period of time. Does that happen again? Possibly, probably, maybe. Pick whatever word you want. So I think my caution is around the trajectory by which we get there, but in terms of the end outcome in 10 to 20 years, you look at movies like The Matrix, Ready Player One, all Wreck-It Ralph, like all this stuff, like it just kind of, it feels like as humanity we're on that trajectory and it's unassailable, but the method by which we get there and when, that's the uncertainty in my mind.
Well, I'm bullish on AI just for a simple reason. I remember the first time somebody recommended Google. I used to use Alta Vista. I don't know if you remember that, but that was the big search engine. And somebody said, "Oh, use Google," and I used Google, and I never used Alta Vista ever again because it was so perfect. And I'm still using it. God, we're actually. Oh, this is weird. Like 25 years on, I think. So I've been using. God, it doesn't feel like it should be 25 years, but I've been using Google for 25 years now. And then somebody first introduced me to ChatGPT, and I've used it nearly every day since. And then someone introduced me to Midjourney, and I use it not every day, but most days. And to suddenly not have it would make my life a lot harder again. It simplifies so many things I'm doing. It's made us more efficient and more productive. And I'm still recommending it to people like Midjourney with you when we're out in Australia. And so I only see it getting bigger, stronger, more powerful, and being used more. I can't see how it goes away.
Yeah. And I think you've just got that flywheel effect where you've got usage, you've got demand. That's self-evident through the delay you experience while you wait for these models to update, i.e. when it takes 3 seconds, when it takes 20 seconds, that is because there is not enough GPUs to process all the demand. So that's a signal in of itself and gives us a level of confidence that there's demand out there for it. But you then use it, the models refine, they provide a better product, people invest in more computing capacity, it gets faster, and you get this flywheel effect that attracts more people, more demand, and it just feeds on itself, and it feels like it started.
Yeah, man. All right, well, listen, usually at this point I say to people, where do you want to send people? But you're a sponsor of the show. Everyone's heard of you now, and they know where to go. But Dan, appreciate you, man. Appreciate everything you've done for me and Danny. And I'm not sure where I'll see you next, but hopefully soon.
Likewise. No, I love what you guys do. Keep it up. Thanks, Pete.
Thanks, Dan. Cheers, mate.